Hello and welcome to Robinhood Stock Market Watchlist video. My name is Carlos. Today is Wednesday, May 18th, and today we'd like to go over some different strategies in this video regarding straddling. But wanted to really make sure that that we talk about how important that moving averages are. Moving averages helps provide us our buying and selling signals. They are kind of like an assistant that lets us know if a stock value is going to be starting to trend upwards or down. And so when we utilize stock options, we can bet a stock goes up or bet a stock goes down. And so, or we can do both at the same time. And when we're in a market that's very volatile, one day the market can surge 5%, or it can also plunge 5%. So a lot of traders and investors sometimes struggle with knowing, what each day is going to be like. But that's the nice thing with straddling, is when you can have both sides. And if you're not exactly sure what options is, there's certain basics, but there are a lot of things to know about options. But the main thing with options is that you do have, like I said, options for several things. But most importantly, that's really popular, is how a lot of investors can bet a stock price can go up, or it can also go down, or you can also do both, and that's called straddling or strangling, where straddling is having the same strike price, where strangling is different strike prices. Maybe the strike price is $5 higher while the other side is $5 lower than the share price. And so but this is kind of the fundamentals. A call is up, put is down. So we'll be talking a little bit more about this. So that's just really, really important to know. And so but these signals, most people's graphs are going to be either lines or candles. And so ultimately, when your moving average line is a lagging price indicator, it lags a little bit compared to what the current price is doing. And obviously, if the price line begins to cut through the moving average line, that lets you know it's beginning to downtrend. And in a normal circumstance, as it downtrends, obviously that would be to devalue. And so you'd want to sell. Or especially if you have a call, if you're having a stock options or a share, and this is the same principle whether you're looking at a 1-minute chart, 5-minute chart, daily chart, or whatever. And so however, if it's indicating it's going to downtrend, that gives us an opportunity to buy a put. If it's letting us know that it's going to go down, we can bet that it'll go down, and while it does, our account goes up. And so same thing here, as the price line cuts through the moving average line, that lets us know it's changing its trending direction. And in normal circumstances, we would buy a share, or we can buy a call, or in the reverse situation, we want to sell our put, because if the price goes up and we're betting that the put goes down, this is the area we would want to sell it. Do not be optimistic. You've got to remind yourself, optimistic is like an emotion. When it comes to trading and investing, you have to keep your emotions out. That is what will affect you, and you do not need that. You got to think strategically and logically. And so if it goes up and you're thinking, oh, it'll go down, no, listen to your assistant. Your assistant is telling you that you need to sell your put, buy a call, or if maybe you can accumulate this throughout the day. It just depends on your situation or your style in investing and trading. You can easily, if it's going to downtrend, buy a put. If you don't want to sell or can't sell, buy a call, counter it. And if it goes up that high, even though you may lose a little bit on your put, your call may outweigh the put. So it's better that you're just covering your bases. So it's just really important to learn and get used to trading both sides. Especially if you're doing this throughout the day. But most importantly, a lot of investors have a lot of different strategies, and each one has different risk levels and everything. But it appears that one of the most when it comes to trading, it's all kind of a high risk, kind of a low reward or high reward, medium reward, whatever. But straddling, we can try to make it as safe as possible, but as rewarding as possible. And one of the pro sayings is follow the money. And there's many ways that a trader can follow the money. However, one of the important rules to many traders is to try to trade shares or stock options with a lot of volume. And so there's a website that we use. It's called barchart.com. It's a free website. On the top left, you just click on the menu area on options, then click on most active options. And so the most active options side of this is really going to show us even when the market is open. It's live information. The order updates every 15 minutes, but it shows us the entire stock options system sorted out by options volume. And options volume is obviously the current day's trading activity. It's buying and selling activity. And so obviously Apple is on the list here. However, when you look at this regularly, you can see what is normally on this list and what's not normally on this list. And what you see here that's normally on this list, Apple is always on this list because it is the most favorable stock option for day traders and swing traders. And because it usually doesn't move around a whole lot. Now, keep in mind, this is Wednesday, May 18th. This was a very, very bearish day. It was a great opportunity for a lot of us. And so, however, look at this options volume. It's 1.4 million versus the second place was AMD at 800,000. And so the Apple was almost twice that. And then this section here also lets us know kind of the ratio, the call ratio versus the put ratio. It's almost 50-50. This is just letting you know that they're straddling, but we don't know exactly when there's uncertainty with the market. We just don't know what is going to happen, because there was some good news earlier this morning with economic reports, and whatever the bad news was, it really dominated it and the market, and it really created a massive amount of bearish activity. And usually something that overrules all that is international issues or international threats. No matter what the media says, they may be just trying to not start a panic, but like I said, there's a lot of bearish characteristics, and so and sometimes the safest play, like an insurance play, would be just to straddle 50-50. And so the best scenario to straddle is to maximize your gains as much as possible. So no matter what kind of platform you use, I'm going to pull up a Webull. Webull is a free desktop application, but it's also a free mobile application that you can download to your mobile phone, tablet, desktop, whatever. And so I have Apple pulled up. This is a 5-minute chart using the moving average graphs. And so this is Wednesday. And so we can see the grayed areas on the side are the, either after hours or the pre-market. After hours is on the right, pre-market's on the left. So the middle areas is basically the middle of the day. And so a lot of people are still, even when they look at the buying and selling signals, they're just not exactly sure when to buy and when to sell. So let's try to take a look at some real life examples here, looking at the moving average charts. Now I use the EMA for my moving averages, and then we have the MACD on the bottom. And so the most important thing is that we listen to the moving average lines, especially when it crosses over. All three of them, when they cross over, that's our last and final signal. There isn't any more after the crossovers, and that's it. Anything else than that could be possibly false, so we have to just be really careful. Even the MACD that says, it's crossing over here, it's just kind of warning us. You just don't want to be too scared. Just wait for that last final crossover. So basically, for Wednesday, when Apple opened up, it was down like 1.5%. And so using the 5-minute chart, it's a much smoother one versus the 1-minute graph. It may provide you too much buying and selling signals, and it just may be a little too confusing. So the 5-minute chart is just much easier to identify better, buying and selling signals. And so, like today, if you had, so yesterday Apple closed just under $150. Right now, it's just under $141. It's down just about $9. And so so if you buy your calls and puts the previous day, it's important to try. You can do whatever you want, but like I said, if we try to optimize this, we want to try to maximize our gains on one side and minimize our losses on the other side. And so you'd want to, you can possibly hold. You could sell, since the market was down. You could sell the calls, but then you're at risk if it bounces back and goes the opposite direction. And so that's why it's important just to kind of wait for the first few signals. That way you may be able to recover some on the other one. If not, if it just keeps going down, the other one's just going to keep gaining. Eventually the other one can only lose so much, and so basically, so this chart's letting us know to basically hold everything. The price is below all three moving average lines, and it has not crossed over. So you continue to hold until it tells you when to do something, and that is when the price line cuts through either direction of the moving average lines, and the moving average lines crosses over each other, and the colored bars are in opposite directions. It almost did right here. It could have scared some people. They could have sold, bought, whatever, but it continued to go down. Did not say to sell it. Now the best thing to do then is because it went from you could have bought either a $150 call and a put or a $149 call or put. It was always kind of in between that around close previously. However, getting down here on the bottom, it's been hovering around that $141, $140 range. And so you'd want to sell your calls and puts, get rid of that from the previous day and start over. You basically buy either your $140 call or your $140 call and put, or your $141 call and put. One of our important rules that we've formed within our group is that to maximize our gains and minimize our losses is to make sure that we are implementing some volatile settings, or settings for some volatility. And so for that, when we select the criteria that's needed, again, we're using the Webull, and I have some settings here that shows basically the strike price. We have our calls on the left side, which are betting the stock goes up. We have the strike prices here, the share prices right here in the middle, versus the puts with the down arrow letting us know this is the area that we would select to bet against the stock, betting that it'll go down. And so you can see, so if let's say the previous day we bought the $150 call and the $150 put. And so today, at the end of the day, if we would have, just got rid of everything on because Apple was down, 5.5%, you would have lost 93% on the call. However, on the put, betting against it, betting that the stock was going to go down, and it did, you would have gained almost 300% on that one side. And so that gain kind of washes out the loss on the other side and puts you ahead. And so, and you want to repeat the process. And so in this case, as you sold the $150 call and put, and the price is hovering around $140, $141, this is where you can now reestablish by buying back the calls and the put at a different strike price, because every day usually the share price is going to be a different price. So the idea is to buy at the money, and the money is the share price. So you want to try to stay there because it has the least amount of time decay, the least amount of depreciation, even though you may see bigger gains in higher areas. But it's just making it a little bit more risky, just in case if it didn't reach that, you would have a little bit more time depreciation. But it's important to try to stay within grasp, within an arm's reach, kind of thing, where it's within 2-3%, 5%. Otherwise the system will just kind of increase the time depreciation on ones that are further out. And so it's important to try when at the end, right before close, at least, right before 10 minutes before the market closes, try to buy an equal amount of contracts of the calls versus the puts, like 100 calls and 100 puts. And within the same dollar amount, and so you can see that right here, as the Apple share price is pretty close to the $140 one call. You can see right here that it has the same bidding price, or pretty close to the same bidding price, or at an asking price. Maybe off maybe by $5-10, but it's within proximity. And so and you want to try to keep that the same dollar amount. Now sometimes if it was $140.50, then the equal dollar amount may be where you would have the $140 or $141 call strike price, and then the $140 put price, or the strike price. And so but just try to keep it balanced. Otherwise that can offset things if things don't go your way. If you try to off balance it, you're just going to have a 50% chance that it's going to be in your favor, and 50% chance that it's not in your favor. So you might as well just keep it 50-50, and you'll kind of balance things out. And you can easily make overall throughout the week, you can double, you can make 20%, 100%, whatever. All right, if you just do this consistently, you can do very, very well. Obviously, as you can see, these are very high percentages, especially in a market that's very volatile right now. And so again, this is just one of the best and safest methods. And also, and very importantly, is to try to select one of the most current, soonest expiration dates. As of we're in this week, so this would be May 22nd. So there's other dates here, and so the reason why you want to select the most recent expiration date is because it maximizes the volatility, and that's what we need. Volatility is one of the key ingredients in making these gains work. And so you can see with the soonest expiration date, we see a lot of the 300%, 400, 500, 800, whatever. Now, if we change it, just kind of watch this. So let's say we change it to May 27th. So that's in another week. You can see that now the the gains are not that much. And so it's just it just, same thing. And so the idea is we just got to get in, get out, get in, get out. And you just kind of refresh, with different, you just follow the money, just keep telling yourself, follow the money. And that's just, one of the rules that are good just to kind of implement. And so, so I just kind of wanted to kind of go over that there. Now we can kind of take a look at maybe another day. Let's say, so this is, this was Tuesday. So this is Tuesday's Apple graph. And so I can't remember. So Tuesday, I think Apple was, Apple was very volatile as well. But you can see that, let's say the previous, you're holding your calls and puts, and it begins to go down. And so this is letting you know that that the share price is beginning to come down, and that is a good indication to begin to sell if you're holding a share, or to sell a call, or maybe it's time to buy a put. And you can see now that the MACD is kind of following this, because maybe the day is a little more volatile versus what it was like today, where it was just straight down. And so with this, we can see that the MACD kind of helps follow this and provides us a little more better synchronization. And so so it kind of helps let us know, okay, this is a good time to either, sell your call and or to buy a put, hold on to your put if you're holding on, if you still have it. And so as you're holding on to your put, this is where it's letting you know it's beginning to change its trending direction. And so this is where you can begin to sell your put. And if you want to day trade, now that you have eliminated your call and put, and secured some gains, you can begin to buy a call, and because it's letting us know it's beginning to change trending directions, it does that. And so, however, it does provide us a quick signal right here. Maybe it's just trying to call our bluff or whatever. Definitely a false signal, but it definitely has crossed over. And so, but it definitely began to recover after this little point here. And so that's good, because if it would have went down, hadn't really, quite crossed over and just kind of kept going up, and so that's good. So hopefully, just kind of kept you in the game there. And so, but it's still letting us know it's trending upwards, so, and then right here, you can kind of notice the MACD is letting us know, hey, it's getting ready to go down, and you can see that it just kind of quickly drops a little more, violently. And that's kind of where you'd want to, sell your call, begin buying, puts, but, or just kind of wait, especially at that point there, there's a lot of, there could have been some, presidential speeches or whatever, or a press conference going at the White House, whatever. And so that can cause a little, disruption. And that's why it's really, really important that you know the schedule of what's going to happen before it happens. That way, if this is going to happen or not. So that's something we really talk a lot about in our group and in our chat rooms. And so we can see now it just kind of continued where it left off. And so but definitely this is where it's really important, where we start to load up heavy on our straddling strategy going into the next day. Whether you want to day trade throughout the day or not, you don't have to, but it's important that we sell usually within the first hour or two, according to these signals. If it doesn't say to sell or whatever, don't sell. Hold. If it's going all the way down, ride that all the way down, or up if it's going up, and until it tells you when to buy and when to sell. Just try to listen to it, to our guide, even though it may provide us some false signals, whatever. We may stumble from time to time, but we're going to hit some home runs. That's going to make you a lot of money, and that's what this is all about. And so, but yeah, again, it's really important, right? Like within the last 10 minutes or whatever before close, that's when we want to load up on all of our calls and puts going into the next trading day. And so let's take a look at, so this is the Monday. So Monday is just kind of the same thing. Monday opens up, it's pretty low. And so we're just kind of waiting to see, what happens. And so, it begins to, and that's where, like I said, it can be kind of, and I can't remember how low Apple was on Monday, but this is kind of where, it can get a little tricky. You can wait until later on, because there wasn't really anything scheduled to happen on Monday. So Monday Apple was really was hovering around 0%. I mean, this was like 0% was like right in here, right in the middle, and that's all it was doing. It was just hovering around 0%. Wasn't really doing anything, and it wasn't really. If you're holding your stock, if you're holding your straddle, it just wasn't really doing anything. And I mean, even though the market, it was up there for a moment, but it just fell flat. And but we're really looking for those big volatile days, and one of the best ways to know if a day is going to be volatile or not is to know. Let me change screens here. Is to know whether if a day has something scheduled that is going to create a lot of volatility. And so other than international chaotic news that can really override and disrupt any type of bullish news or characteristics, which isn't normal, but typically from what's normal, that has one of the most biggest impacts in the stock market is economic reports. And a lot of us will use this free website or an application you can download from your app store. It's called investing.com. But the important part is viewing the economic calendar, because the economic calendar, again, anything that has a schedule, anything with a date, that's really important, because that means something's going to happen. It's usually something good or bad, and so we have to know what's going to happen before it happens. And so we're in the economic calendar. If you're on the mobile application, it's a little calendar icon that you click on, and then there's just some settings and stuff within here that we have to configure. But so there's a filters icon that we have to click on, because for the most part, we're just going to see a bunch of gibberish. We want to try to simplify things as much as possible to make it as easy and convenient for you. So we want to click on filters, and then there's going to be some things that are checked in here. You just want to clear it all. Just clear everything. Just click on the clear button, and then that'll just wipe everything. There's only two things that we need to see, and that's a check mark under United States. Right there, and then under importance, we have a 1 star, 2 stars, and a 3 stars. We want to put a check mark under 3 stars, and then click apply. It'll then refresh, and then you'll begin to kind of see some information. However, let's click on this week, and so we see that the schedule that has everything that has the biggest impact on the stock market. And starting with Tuesday, May 17th, so that was yesterday, we had the core retail sales month over month. That's why it says MOM or MOM for the month of April, though. And so, and then you have the regular retail sales month over month for the month of April, and then the federal chairman, Jerome Powell, who speaks, that has a big influence in a lot of things, but creates a lot of volatility with the stock market. And so the important part is knowing a lot about these numbers, but keeping things basic and simple, less is more, is knowing, is really looking at the previous versus the forecast. So previous is obviously what it was before, and so forecast is what they think that's going to be now. And so that's basically letting you know, and especially most of these numbers, the forecast needs to be higher than the previous. If it's lower than the previous, that's bearish. And because we need things to keep going. We need to always do better, hit our record, breaking, whatever. And so if the previous was, up to 0.1%, now it's going to be 0.4%, even though it was 0.6. It was higher than the forecast. Yeah, that's good, but also, another way, it's kind of bad compared to, the previous. But at least it was up a little better, but that just may have caused the market to be a little weird, because it's just not that the greatest news, even though it did okay. But so it was just kind of weird. Expect mixed signals, and so and then going into Wednesday, we saw the building permits and crude oil inventories both did really well, but unfortunately the international news kind of powered the stock market system. So and then Thursday, going into tomorrow morning, May 19th, we have the unemployment report. So, and it's important to look at these times. If you're looking at the on the website, it's going to be based on the East Coast time. If you're looking at on your mobile phone or your tablet, it's going to be based on your time zone, because it's pulling it off of your mobile device. And so it's important that you are aware of, if you're looking on the website, versus your time zone, that you're, matching it up correctly. So, but basically with the previous report, and this is a weekly report, where last week was, it was up to 203,000, but they anticipate that in forecast that it'd be down a little bit, around 200,000. It's been hovering around 200,000 for quite a while now. That seems to be kind of the bottom point. So we'll see what happens. Then we have the Philadelphia Fed Manufacturing Index for the month of May. You can see that it is also forecast to be a little lower. However, the unemployment report and the crude oil inventories, these are one of the reports that we need these numbers down low. Lower the better. Lower is positive. Usually anything else, the numbers need to be higher. And so with the Philadelphia Fed Manufacturing, the number is forecast to be lower than the previous one. That is bearish. And so we'll have to see what happens. If the number comes back lower than the forecast, that's going to be extremely bearish. If it's up past that, but maybe between the previous, it can be mixed. If it's better than the previous, that I would say that's bullish. And so that's really, really good, because now it has meet and beated the previous record. So that's good moving forward. And then you have the existing home sales. So also another thing to notice, even though this is 8:30 Eastern time, this is 1 hour before the stock market opens. So it's important to know if this is something that's affecting a pre-market or not, because maybe when the stock market opens, it may continue and enhance that characteristics throughout the day. So we have to utilize these moving averages and stuff, when to get in and when to get out. But we have a better idea of how the stock market feels based on this information or other events that are taking place, especially with the war and stuff that's going on, across the world. And so existing home sales, it's obviously, like used homes and whatnot, for the month of April. Previous month for March was 5.77 million. They expect it to be down a little bit. Obviously, what they're showing us is that there's a slowly declining in home sales, because interest rates are outrageous right now, and they're just getting started. A lot of people knew that this was going to happen. They've already bought in their homes and stuff before these interest rate hikes and everything, and so we're going to see a decline in this, and that's bearish. And so Thursday, going into tomorrow, it looks bearish, even though the U.S. futures might be up a little bit. But again, this is just really, really valuable, important stuff. That way you are aware of what's going to happen before it happens. But like I said, there could be definitely some interference or some manipulation and stuff. But this is a very valuable tool that really helps with a lot of our strategies and stuff. But ultimately, follow the money. When we're looking at the overall options activity, the most active options, again, follow the money. We're talking millions and millions of dollars. People are straddling. they're buying both calls and puts. It's one of the most safest plays, other than just picking one direction over the other. I mean, you can do that, but you're just so much more at risk when it's really important to stay consistent. Just stay consistent. That should be one of the rules. Keep the emotions out, and just focus on what all the other, what the majority is doing. I mean, we have Apple there, we have AMD, we have Tesla. These are all very, very volatile stocks. Stay away from AMC. There's just too many. I believe there's just too many people that are just holding on to hope, and they may have a lot of shares or calls on this, and they're just constantly losing money on it and trying to lower their average costs. And so just don't be a part of that, and just focus on the primary stuff. And Apple should always be your primary play. Anything else, especially if you're doing earnings plays, because earnings or any other massive news like splits, anything that has a big, huge, weird impact on the stock can create what's called IV crush, which means implied volatility crush. It can lower the value of both calls and puts instantly and dramatically. It's a killer, and but it only happens when there's something massive that or change with the share in the stock, and so those should be a lottery play. I mean, you could hit huge on those. Let me show you here. So we're going to switch back over to Webull, more straddling here, but we're going to talk about Target. Target had a earnings recently, which we always go over the earning plays for the week. And so Target had their earnings earlier this morning, and so it plummeted. It had plunged about 25%. And so if you had calls and puts on that, I mean, it was around $217. So if we go over to the options area, let's go. We need. We'll just look at the 100 and let me see. Let's go to 200. 200 right there. So we have the 200 on the top. So let's say that we had the calls and puts, and so it plummeted 25%. You would have lost almost every. You would have lost on the calls. You would have lost on the calls, but look at the gains. You would have gained 2,000%. I mean, that is in one day. I mean, that is huge. But like I said, we see all these other bigger ones. You can just try to stay around the money, and that's where $200 would have been more realistic at the time. And so, but 2,000%. Never be greedy, even though this is huge, gains and a lot of money. This is massive and life changing. And so, but it's just better to have. I always say when you're straddling, you can only lose what you have in one hand, but the gains in the other hand are potentially unlimited. And so it's just much safer. It's really easy once you kind of get used to it. As a group here, we're a huge support. If you have any questions, just let us know. And this is, but like I said, stick with. Let me go back to the bar chart website. Like I said, follow the money. Stick with the majority. Like I said, if you're going like all in type like person, this would be it. But if you're doing other things, other small things, then that should really be like maybe 10% of your capital or 20%. But the majority of your capital can easily go, or your investment, your buying power, whatever, should be focused on trading Apple regularly every single trading day. And so another way you can kind of follow the money is, again, the most active options was, again, the whole entire system. But over here on the left, back on the options menu, we have the option volume leaders. And so with here, it kind of gives us the most active individual calls and puts. And it's, again, sorted out by volume. So today's most active individual call and put was Apple. It was $150 call strike price that expires this Friday on the 20th. DTE is basically the number of days until the option expires. So it's good to kind of look at that. Kind of gives you an idea of how many days it is for this particular call or put. So it's very interesting. So again, as we're looking at this stuff regularly, no matter what page that it is, there's stocks options that are here all the time, like Apple, AMD, Tesla, whatever. However, there are certain ones that are not normally on this list. Like this EQT, I have no idea what that is, but now all of a sudden it's on this list. But it's interesting that the share price is basically already at the strike price, and it already has that. So it just gives us some reason to do a little bit more due diligence on it. And we can see the open interest right here, the open interest, the total number of open option contracts that have been traded but not yet liquidated via offsetting trades. And so, and a lot of that stuff is kind of like previous information or activity prior from the current trading day, versus the volume is the total number of shares of contracts traded for the current day. And so you can see that the amount of volume on this is greatly exceeds over the open interest, because the open interest is really an accumulation of activity over time, and versus the volume, all this in one day, almost 2.5 times the open interest of that has accumulated over time. And so that really shows an unusual amount of massive buying activity. And so but we can kind of look at overall the big picture. If you're looking at calls, puts, you can kind of see that there's numbers are kind of similar. Obviously, this is a lot, straddling activity, as well as maybe individual day trading. But you can kind of see, a lot of neat other things like AMD, have the JD, and so on. You can kind of go down the list as well, and unusual options activity right there, kind of has other stuff. But also the straddling and strangle area. There's 4 little sections to them, and all of them are very similar, but it's very wise to check all 4. Now the idea is to try to find unusual activity, and the best way to find unusual activity is to find the straddle and strangle straddle activity with the same stock options. The more stock options, that means there's just more straddling going on with it. And so, but you have short, long. Short is basically it's just what it is. But you can see that there's Apple here multiple times. So we have 4 here if we wanted to count it on down. I don't see any others. We have 4 there, and then we have the JP Morgan. So we have a 1 and a 2 right there. BP and XOM. I think the MU right there. So we have a couple, but Apple so far has dominated this list. But there are a few. Some days there's nothing on here, but like I said, usually in the middle of the week we'll start to see more activity in different areas. So if we could click on the long straddle, again, straddle is the same strike price, versus strangle or different strike prices. And that's why you can see that like the 10C, that means the call, or the 10P, meaning the put. So versus the other ones, like I said, there'll be different numbers. So again, we want to look for multiple of the same stock options. So starting from the top, just kind of work our way down and see if we can see multiple of the same one. I don't really see a lot of the same one here, so which is fine. There is an Intel INTC there and right here, and there's a couple C's right here. but not like a bunch. They're just kind of, not like the Apple that was on the top of this list and they were all kind of clustered together. That's a great indication of that's what investors are doing. And so long put, or not long put butterfly, short strangle, we'll click on that, kind of look for the same thing. We have a bunch of AMCs. Like I said, I just recommend staying away from that one, even though it's on the list and in some other areas. The time decay on AMCs is very rapid, and like I said, it's just it shouldn't even be on here, but it's just created a lot of hype and activity and stuff, through time. So we'll ignore AMC, and then we'll keep going down, and I really don't see anything other than that. So we'll click on the last one, long strangle, and just take a look at any other unusual strangle and straddling activity. So starting with the top, kind of work our way down. We have the Intel there, but don't see any others. And then keep going down and see a couple AMDs right there. There's an Apple there and another Apple right there. And it's about it, but it seems like a majority of it was the first one. But at least you can kind of see which ones people have gotten, as well as the expiration date. If you wanted to really see what kind of people are doing, we got the expiration date right there. You can see we have the $140 call and the put, and then we have the since this was the June 10th expiration date, we have a July 15th with the same strike price call, the $140 call and the $140 put strike price. Now again, if you have a much longer expiration date, it's going to be a lot less time decay, it's going to be more expensive, but it's going to be a lot less volatile, and that may be your thing, because based on your time, you may not have a whole lot of time to kind of look at this stuff, but maybe you do. And so but if you do, and you really want to try to maximize the opportunity, and that just depends on your budget, but also your but ultimately it's the expiration date is going to control that level of the volatility. However, to maximize it, like I said, you want to have the most soonest expiration date possible. So hopefully this information has helped you guys. Again, we're always here in the chat room or in our Facebook group if you guys have any questions, and I'll make more videos on other things. And so but hopefully this information has helped. We'll see you guys soon.